The death of a currency never looks like death in the beginning. It looks like strength. It looks like dominance. It looks permanent. Every global reserve currency in the last 6 centuries began at the top of the world and ended in the same graveyard. The Portuguese real, the Dutch guilder, the British pound, each ruled global trade, each commanded the oceans, each accumulated the world's wealth, and each collapsed, not because of one event, not because of one war, not because of one policy mistake, but because of a cycle, a predictable, mechanical, 7-stage sequence that transforms every reserve currency from a weapon into a weight that drags its empire underwater. And the United States dollar, once the most powerful financial tool ever created, is now deep inside that same cycle. That's the part nobody wants to say out loud, because the U.S. has held reserve status for 81 years, almost the exact lifespan of every reserve currency that came before it. Portugal, 80 years. The Netherlands, 80 years. Britain, 105 years. America, 81 years and counting. The pattern is not emotional, it's mathematical. And if you zoom out far enough, if you strip away the politics and the narratives and the noise, you see something chilling. Every reserve currency dies the same way. And the US dollar is already past the midpoint. This isn't prophecy. This isn't ideology. This is the same sequence playing out for the 4th time in financial history. A sequence so consistent that even empires that understood it couldn't escape it. First, military supremacy, then global trade dominance, then the world adopts your currency, and then, slowly, invisibly, the decay begins. Surpluses turn to deficits, production turns to consumption, power turns to privilege, privilege turns to dependency, and dependency collapses into debt. The cycle accelerates. And once a currency becomes dependent on the world holding it, the world gains the power to walk away. You can see the early symptoms in every empire on the brink. A widening trade deficit, runaway fiscal spending, debt levels rising faster than economic output, financial engineering replacing real production, and a political class that tells itself a familiar lie. This time is different, but it never is. Because reserve currencies don't collapse from external attack, they collapse from internal rot, from incentives that shift the system away from strength and toward fragility. Right now, in 2025, the U.S. is experiencing the same conditions that emerged in Britain in the 1920s, in the Netherlands in the 1700s, and in Portugal in the 1500s, the moment when dominance becomes dependence, and dependence becomes danger. And once the cycle reaches this stage, history shows something unavoidable. No reserve currency has ever reversed it, not once. Which leads to a question far more important than whether the dollar falls. The real question is where we are in the sequence, and how far the cycle has already advanced. Because if we're early, there is time. But if we're late, then the most powerful currency in human history is entering its terminal phase. And the answer becomes clear only when we rewind the tape, back to the beginning of this pattern, back to the empires that rose and fell before America ever existed. Back to the origins of the currency death cycle. To understand where the dollar is going, you must first understand where every reserve currency went before it. And that story begins centuries before the dollar was ever printed. To understand where the dollar is heading, you have to step out of the present, out of 2025, out of the headlines, out of the noise, and travel back to the moment the cycle first appeared. Because the currency death cycle isn't modern. It isn't American. It isn't even industrial. Its roots stretch back 6 centuries to a world lit only by fire, where the first empire discovered the formula for global monetary power, and unknowingly, the formula for its own destruction. 1450, the birth of the first reserve currency. Picture Europe in the mid-15th century. Small kingdoms, fragmented trade, primitive finance. The world's wealth flowed through land routes controlled by the Ottoman Empire. No European nation could break through, until one did. Portugal, a small, wind-swept kingdom on the Atlantic, made a discovery that would change the economic architecture of the world. Not a discovery of gold, not of spices, but of navigation. For the first time, European ships could cross open ocean. This breakthrough wasn't technological convenience, it was geopolitical dominance. In 1488, when the Portuguese rounded the Cape of Good Hope, they bypassed Ottoman trade routes entirely. They created a new artery of global commerce and armed it. Portuguese fleets fortified every choke point: Goa, Malacca, Macau, Mozambique. They enforced trade at Cannon Point, and because they controlled the routes, they controlled the currency. Merchants across 3 continents needed Portuguese reais to trade in Portuguese waters. Money followed power, and the first reserve currency was born. But what Portugal didn't understand, what no empire understood, was that the moment your currency becomes indispensable, the seeds of decline begin to grow. 1600s, the Dutch reinvention, a century later. A colder, smaller nation perfected what Portugal began. Amsterdam didn't dominate the seas the way Portugal had, but it dominated something far more dangerous: finance. The Dutch East India Company fielded its own armies, its own fleets, its own colonial network, a corporation more powerful than many nations, and Amsterdam became the financial clearinghouse of the world. Bills of exchange, international contracts, global liquidity. For the first time, the world needed a financial instrument more than it needed a navy: the Dutch guilder. The guilder wasn't just money, it was infrastructure, the backbone of a system that made the Netherlands the richest nation on earth. But the cycle tightened again. The stronger the guilder became, the more the Dutch consumed. The more they consumed, the more they borrowed. Wars with England drained the treasury. Debt rose, and the death cycle moved forward. 1800s, Britain perfects the machine. By the 19th century, Britain had refined the model into its ultimate form. No nation in modern history controlled more economic arteries than the British Empire. The Suez Canal, Singapore, Gibraltar, the Straits of Malacca, every point through which global trade flowed. Britannia rules the waves wasn't a slogan, it was a balance sheet. The pound sterling became the anchor of global finance. International loans, commodity pricing, imperial taxation, London was the center of gravity. This was the peak of the pattern. What every reserve currency eventually achieves: global indispensability. But as always, indispensability came with a cost. Industrial supremacy led to complacency. Complacency led to deficits. Deficits led to dependence on foreign borrowings. And 2 world wars accelerated the cycle faster than any empire before it. By 1944, Britain didn't walk away from reserve status, it was replaced. 1944, the dollar ascends at Bretton Woods. The United States emerged with unmatched industrial capacity, unmatched gold reserves, unmatched military dominance. Every other major power was rebuilding from rubble. America was producing for the first time. The world agreed, formally, explicitly, on a single reserve currency: the US dollar, convertible to gold at $35 per ounce. What Portugal had created, what the Dutch had expanded, what Britain had perfected, the United States now commanded on a scale unseen in human history. But hidden inside this triumph was the same flaw that destroyed every empire before it. Once the world needs your currency more than your goods, the decline has already begun. Bretton Woods wasn't just a monetary agreement, it was the beginning of Stage 3, the peak of the cycle, and the point from which every reserve currency begins to rot internally. America wouldn't realize this for decades. Most empires never do, and that raises the question we must now confront. If the pattern is this consistent, where exactly is the dollar in the cycle today? The fall of a reserve currency never begins with collapse. It begins with success and too much of it. Because when a nation becomes the center of global trade, global finance, and global power, something subtle happens inside the system. The incentives shift. The structure bends, and slowly, predictably, the empire crosses a line it can never uncross. Every reserve currency follows the same arc, and the proof is not in one empire, but in all of them. Let's walk through the cycle, not as theory, but as the lived reality of 4 nations that once believed their money would rule forever, and learned otherwise. Portugal, the first ascent, the first collapse, stage 1-7 compressed into a single century. Portugal's rise was explosive. Control the seas, control the goods, control the currency. For 80 years, the Portuguese real was the lubricant of global commerce. But once the real became indispensable, a familiar transformation began. 1. The trade surplus turns inward. Portugal extracted wealth from the world, but it didn't invest enough of that wealth into its own productive capacity. It consumed more than it built. Cheap Asian goods flooded Lisbon. Domestic industries eroded. The empire became dependent on foreign imports financed by its own currency's dominance. 2. The military edge erodes. As rivals copied Portuguese naval innovations, the monopoly vanished. The Dutch and English began undercutting Portugal's trade routes. 3. The currency loses its backbone. When your economic engine relies on foreign goods, your currency stops being backed by production and starts being backed by hope. By the early 1600s, the Portuguese real had begun its steady decline. The currency didn't implode overnight, it wilted, starved by a system that rewarded consumption over creation. The pattern had begun. 2. The Dutch guilder, the financial superpower that over-leveraged itself. The cycle becomes more sophisticated. The Netherlands built the world's first financial empire, central banking, stock exchanges, global credit markets. The guilder was not just dominant, it was the operating system of 17th century commerce. But beneath the innovation lurked a dangerous shift. 1. Financialization replaces productivity. As Amsterdam grew rich, the Dutch economy became more financial than industrial. Ships mattered less than paper. Credit mattered more than goods. It was the same transition every reserve currency eventually makes, the pivot from producing economic value to extracting financial value. 2. Debt explodes. Wars with England forced the Dutch government to borrow heavily. The guilder's strength allowed it, but that strength masked the fragility beneath. 3. The currency becomes a liability. When foreign nations hold your currency as reserves, they also hold the power to dump it. Confidence is everything, and when confidence shifts, even the strongest currency can break. By the early 1700s, after a century of dominance, the guilder entered decline. The cycle tightened. The third, the British pound, the longest rule, the slowest fall, the most powerful example before the dollar. Britain perfected the empire model, military might, industrial power, financial sophistication. At its peak, the British pound was used in over half of global trade. London priced commodities. British banks issued international credit. The sun never set on the empire, nor on its currency. But the cycle, once again, proved inescapable. 1. Industrial supremacy. Imported consumption. As British wealth surged, the country shifted from exporter to importer. Cheap foreign goods outcompeted local producers. Factories slowed. The domestic economy softened. 2. The empire becomes expensive to maintain. The cost of controlling the world, militarily, administratively, financially, grew heavier each decade. 3. Debt becomes structural. 2 world wars accelerated the decline with brutal efficiency. Britain borrowed massively, first to fight, then to rebuild. The pound became a reserve currency backed less by gold and production, and more by obligation. By 1944, the British pound was no longer the world's anchor. The system transitioned to the dollar not by negotiation, but by inevitability. View. The United States, the most powerful, the most vulnerable. The cycle reaches its most advanced form. The U.S. learned from every empire before it, but also repeated every mistake. After World War II, America was untouchable. Industrial dominance, control of trade routes, massive trade surpluses, the largest gold reserves in history. The dollar became the global reserve because the world needed American goods, and because the U.S. could actually deliver them. But the cycle had other plans. 1. Surplus, deficit. 1960s, 1970s. Other nations rebuilt. American manufacturing peaked and began to erode. Cheap foreign imports replaced domestic production. 2. Bretton Woods breaks. 1971. When foreign nations demanded gold for dollars, the U.S. realized the truth. The world held too many dollars, and America held too little gold. Nixon closed the gold window. The dollar floated. The cycle advanced. 3. Financialization becomes the core of the economy. From the 1980s onward, the American economy shifted dramatically. More consumption than production, more debt than savings, more financial engineering than industrial expansion, more imports than exports. The dollar's dominance made the transition possible and ensured that the consequences would be global. 4. Explosive debt. $2,000 today. America's fiscal deficit became permanent. Its trade deficit became structural. Its debt became exponential. A pattern that once took 100 years for Portugal, 80 years for the Dutch, and 120 years for Britain has now accelerated to mere decades. The reason? The dollar is not just a national currency. It is a global dependency. And global dependencies collapse faster. The cycle revealed across all 4 case studies, Portugal, the Netherlands, Britain, and the United States, the same mechanism appears. Stage 1, military trade dominance. Stage 2, massive surplus. Stage 3, reserve currency status formalized. Stage 4, consumption replaces production. Stage 5, debt expands exponentially. Stage 6, financial engineering masks structural weakness. Stage 7, loss of confidence, decline, replacement. The names change. The tools change, the technology changes, but the math does not. Every empire becomes addicted to the privilege its currency provides, and every empire fails to see the cost of that privilege until it's too late. Which brings us to the unavoidable next question, the one this cycle always forces. If the US is following the same pattern, where exactly is the dollar right now? To understand where the dollar stands today, you don't start with politics. You don't start with headlines. You start with the numbers, the cold, mathematical signals that have predicted the decline of every reserve currency before it. Because once a currency enters the late stages of the cycle, the symptoms stop being subtle. They become structural. They become visible. They become impossible to hide behind financial engineering or political narratives. And in the United States, those symptoms are no longer emerging. They are fully formed. The end of the surplus era, a permanent deficit machine. Every reserve currency begins with overwhelming trade surpluses. Every reserve currency ends with permanent trade deficits. The U.S. crossed that line half a century ago. 1. The U.S. corridor has not run a trade surplus since 1975. Not 1 year. 50 straight years of deficits. The longest uninterrupted deficit streak in modern history. Imports exceed exports every year. Not because America cannot produce, but because it no longer needs to. The world demands dollars, so America prints them. Other nations produce goods to earn them. This is Triffin's dilemma in its purest form, a structural requirement that the reserve currency nation must supply more currency to the world than its own economy would naturally justify. The privilege is real, and the price is fatal. Second, fiscal decay. Debt becomes the economy. Reserve currencies die not from competition, but from internal excess. And the United States has entered the same stage that destroyed Britain in the 1920s and the Netherlands in the 1700s, the era of exponential debt. 1. The U.S.'s national debt has passed $37 trillion, more than any country in human history, more than the entire global economy produced in 2002. 2. Debt to GDP now exceeds 130%. Higher than at the end of World War II, but without the post-war industrial boom that once paid it down. 3. Interest is now the fastest growing federal expenditure. In 2025, interest payments exceed the entire defense budget. By 2027, they will exceed Medicare. By 2030, they will challenge Social Security itself. This is the point every empire reaches, when the cost of yesterday's borrowing consumes the capacity of tomorrow's economy. Britain experienced it in the 1930s. The Dutch experienced it in the 1700s. Portugal experienced it in the 1600s. The pattern is unmistakable. Third, financialization, the final transformation of a dying reserve currency. Every currency that reaches the late stage undergoes the same internal mutation. Its economy shifts from production to consumption to leverage to speculation. The U.S. has completed that transformation. 1. Manufacturing as a share of GDP has fallen for 5 decades, not because the U.S. lacks innovation, but because financial incentives reward debt, not industry. 2. Corporate profits rely more on financial maneuvering than production. Stock buybacks exceed capital investment. Debt-funded acquisitions outpace factory construction. Derivatives volumes dwarf real economic output. 3. Silicon Valley is now the industrial base, not steel mills, not shipyards, not manufacturing hubs, but networks, platforms, data, and financial flows. This is the same stage the Dutch reached when Amsterdam became a financial empire rather than a trading empire. The same stage Britain reached when the city of London overtook its industrial north. Once a currency becomes the foundation of global finance, its domestic economy inevitably shifts toward financial extraction. And once that happens, reversal never occurs. The dollar's privilege turns to dependency. Here is the irony that destroys every reserve currency. At the peak of power, the world needs your currency. In the decline of power, you need the world to need your currency. The U.S. now sits in that second phase. 1. Foreign nations hold trillions in dollar assets. China holds $2 trillion in total dollar exposure. Treasuries, corporate bonds, equities, reserves. They cannot dump them without destroying themselves, but they no longer accumulate them at previous rates. They are quietly diversifying into gold, into commodities, into regional trading blocks. 2. The petrodollar system is eroding. Saudi Arabia is signing energy contracts in yuan, rupees, and euros, not exclusively dollars. Oil pricing outside the dollar breaks the backbone of the system built in the 1970s. 3. Global reserve diversification accelerates. Central banks worldwide have been buying gold at record levels for 2 consecutive years. The last time this happened, the decade before the pound lost its reserve status. Dependence becomes vulnerability. Vulnerability becomes risk. Risk becomes inevitability. The cycle deepens. V. The final marker, money printing as the default solution. A reserve currency reaches the end of its cycle when debt grows faster than the economy can service it. At that point, every empire chooses the same path: print, devalue, inflate, extend. The US has already crossed that threshold. 1. Between 2020 and 2022, 40% of all dollars in existence were created, not gradually, instantly. 2. Every crisis produces the same response: expansion of currency supply. COVID, bank failures, geopolitical shocks, recession fears. The system now requires new money to prevent collapse of old debt, a classic sign of stage 6 in the currency death cycle. 3. The government is preparing for a monetary reset. Policies involving gold and Bitcoin accumulation are not random. They mirror the early stages of the 1933-1934 gold revaluation, the most efficient debt erasure in U.S. history. When a government begins preparing new collateral for its monetary base, it signals that the existing system is unstable. This is not the beginning of the cycle, it is the prelude to the end. Where the U.S. stands in the cycle. Put all the signals together: trade deficits, fiscal decay, financialization, global diversification, and monetary dependence, and a precise placement emerges. The United States is in stage 5 of the currency death cycle, the same stage the British pound entered in the 1920s, the same stage the Dutch entered in the early 1700s, the same stage Portugal entered just before collapse. Stage 5 is not collapse. Stage 5 is destabilization. It is the moment when the system can no longer correct itself, only delay what comes next. And that leads to the most critical part of the cycle, the acceleration phase, the stage where decline speeds up, timelines compress, and everything becomes irreversible. Every reserve currency in history followed the same sequence, but every collapse moved faster than the one before it. Portugal's decline took nearly a century. The Dutch collapse took 5 decades. Britain's took roughly 30 years. The United States will not have that luxury. Not because America is weaker, but because the modern financial system is faster, more leveraged, more interconnected, and more fragile than anything the world has ever seen. Velocity is the defining feature of the dollar's endgame, and the forces accelerating this cycle are unlike anything past empires ever faced. Let's break down the accelerants, the multipliers, the mechanisms that ensure the dollar's decline will not be slow, gentle, or linear, but sudden, synchronized, and irreversible. Technology has removed the friction that slowed every previous collapse. When the pound collapsed in the 20th century, capital moved through ships, telegraphs, and paper ledgers. When the Dutch guilder collapsed, information traveled at the speed of horses. When the Portuguese real collapsed, half the world didn't even know. Today, capital moves at the speed of light. Trillions can exit the dollar system in milliseconds. A sell-off that once took years now happens in a single trading session. Algorithms don't panic, they liquidate instantly. ETFs don't hesitate, they dump everything the moment signals flash red. 2. Digital settlement makes alternative currencies frictionless. A central bank in Asia doesn't need ships of gold or barrels of silver. They can shift reserves from dollars to gold. When? Or digital assets with a keystroke. 3. Global investors are hypersensitive to signals. A single policy speech, a single inflation print, a single geopolitical shock. All of them can trigger automated flows across the world. The frictions that once slowed the currency death cycle no longer exist. Collapse has gone digital. The 2. Debt levels are historically unprecedented, and they act as an accelerant. Every reserve currency enters decline with rising debt, but no nation in history has carried the scale of leverage that now underpins the American system. 1. 37 trillion in national debt. 2. 100+ trillion in unfunded liabilities. 3. 17 trillion in corporate debt. 4. 13 trillion in consumer debt. 5. A banking system leveraged on top of all of it. When interest rates rise, debt compounds. When debt compounds, default spread. When default spread, liquidity evaporates. When liquidity evaporates, currencies break. This is the final phase of every monetary empire. when servicing the debt becomes mathematically impossible, and the system turns to devaluation as a survival mechanism. Unlike past empires, the U.S. cannot inflate slowly. The debt is too large. The interest burden is too heavy. The timelines are compressed. Inflation becomes not a policy choice, but a structural requirement. Third, the world is already building escape routes from the dollar. No reserve currency has ever collapsed while the world still depended on it. The collapse only begins once alternatives emerge. And for the first time since 1944, alternatives exist. 1. China's payment systems, CIPS, bypass SWIFT entirely. 2. BRICS nations are creating settlement networks that avoid the dollar. 3. Gulf nations are pricing oil in multiple currencies. 4. Central banks are buying gold at record highs, the strongest diversification move since the 1960s. 5. Digital currencies reduce reliance on U.S. banking infrastructure. The world is not abandoning the dollar emotionally. It's doing so strategically, because dependency on U.S. monetary policy has become too dangerous. This fractures the network of trust that every reserve currency requires to survive. Once trust splinters, collapse accelerates. IV. Financialization has turned the U.S. economy into a glass tower. Every empire in decline becomes financialized, but none have become as financialized as the United States. 1. 40% of all corporate profits now come from financial engineering. 2. Derivatives exposure exceeds global GDP many times over. 3. The stock market depends more on liquidity conditions than on earnings or productivity. This creates a system where a small interest rate change destroys corporate balance sheets, a geopolitical shock freezes global credit, a treasury sell-off causes panic across all asset classes. This is the fragility of late-stage reserve currencies, when everything relies on everything else. A crack anywhere becomes a collapse everywhere. The system no longer has buffers, it has amplifiers. De-dollarization is no longer a threat. It's a process already underway for decades. Analysts warned about the risk of de-dollarization. They were early, but they were not wrong. The process has already begun. 1. China is downshifting its treasury holdings to 16-year lows. 2. Saudi Arabia's energy contracts diversify away from dollars. 3. African and Asian blocs are establishing regional currency systems. 4. Russia and China are conducting the majority of trade in non-dollar terms. 5. Global FX reserves in dollars have fallen from 72% to under 58% in 2 decades. This is the same pattern seen in every declining reserve currency. A slow, quiet, deliberate diversification until a crisis forces the final, rapid, violent exit. Stage 6 always begins gradually. Stage 7 always happens all at once. The U.S. government is preparing for a monetary reset. This is the most important acceleration factor and the most misunderstood. When governments know the system cannot be saved, they do not announce collapse. They prepare for transition. The United States is doing exactly that. 1. Accumulating gold quietly. 2. Establishing a strategic Bitcoin reserve. 3. Exploring asset revaluation mechanisms identical to the 1933-1934 gold reset. 4. Structuring policy for a future where the dollar is backed by new forms of collateral. This is not speculation. It is the debt eraser blueprint used by the U.S. once before, now adapted for a digital era. A reset is not collapse. It is the mechanism used to survive collapse. And resets happen quickly. They must. The system cannot endure slow exposure of its own insolvency. 7. Why this collapse will be sudden, not gradual. Combine every factor: high-speed capital flows, record global leverage, structural deficits, worldwide alternatives, fragile financial architecture, government preparations for monetary restructuring, and the conclusion becomes inescapable. The dollar's decline will not resemble the slow fading of the pound. It will resemble a phase shift in a tipping point where the system holds until it doesn't. Every signal that once warned Britain in the 1920s, the Dutch in the 1700s, and Portugal in the 1600s is flashing today, but amplified, compressed, and accelerated by modern technology. This is not the beginning of the end. This is the end of the middle, the acceleration phase. And what comes next is the final chapter of every reserve currency in history, the moment confidence breaks and replacement becomes inevitable. Every reserve currency in history reaches a moment where the world stops asking, will it fall, and begins asking a far more dangerous question: when? The United States is now standing at that threshold, because the currency death cycle does not end with fireworks. It ends with math. And the math, once it crosses a certain point, cannot be negotiated with. voted away, or delayed by policy. The final phase of a reserve currency is not a single event, it's a chain reaction. A moment when confidence breaks in multiple places at once, and the system designed to withstand yesterday's risks collapses under the weight of today's. We are now close enough to see the outlines of that moment. The breaking point always begins quietly. In every empire, collapse begins invisibly. Portugal didn't know the real had peaked until decades after the decline began. The Dutch didn't realize the guilder was done until it lost its military shield. Britain didn't recognize the pound's twilight until the war bills came due. The US will be no different. The end will not be marked by a headline. It will be marked by a collective shift in global behavior, small at first, then sudden, then irreversible. Here is how the final stage unfolds. 2. The first trigger, a loss of faith in debt. The US debt is the foundation of the global financial system. It is the collateral used for international lending, trade settlement, repo markets, derivative pricing, central bank reserves, everything. When confidence in that collateral weakens, the entire structure trembles. It may begin with a single event, a failed treasury auction, a sudden spike in yields, a downgrade, a geopolitical shock, a liquidity freeze in repo markets individually. These are survivable together. They create the spark, because the moment the world begins questioning the safety of US debt, they begin questioning the safety of the dollar. And once that happens, there is no mechanism on earth that can fully restore confidence. 3. The second trigger, foreign holders quietly step away. The US dollar is not supported by domestic demand. It is supported by global demand. When foreign nations, and especially major creditors like China, Japan, the Gulf states, and European central banks reduce their exposure, the decline becomes structural. It will not look like selling. It will look like not rolling bonds, shortening maturities, increasing gold positions, pricing commodities in other currencies, diverting savings into non-dollar assets, building bilateral settlement systems. The world does not need to dump dollars to end the dollar's reign. It merely needs to stop adding new ones. That alone is enough to shift the system into decline, because a reserve currency is not destroyed by attack, it is destroyed by abandonment. IV. The third trigger, domestic pressures reach the point of no return inside the United States. The end of the cycle arrives through internal contradiction, deficits too large to finance, debt too large to service, entitlement obligations too large to meet, political division too deep to resolve. At that point, the government faces only two choices: raise rates and destroy the economy, or print money and destroy the currency. Every empire in history chose the second, not because they wanted to, but because they had no other option. Debt is not repaid. Debt is inflated away. This is the moment the currency death cycle reaches its final act. V. The fourth trigger. A global shift to hard assets. Every dying reserve currency faces the same migration of global capital. It moves into assets that cannot be printed: gold commodities, energy reserves, productive land, strategic metals, alternative currencies, digital stores of value. This is not a panic. It is a rotation, a quiet understanding that the currency world is entering its next chapter, and that purchasing power stored in the old system will not survive the transition. This shift accelerates inflation inside the reserve currency nation and accelerates deflation outside it. A dual collapse dynamic emerges, and confidence, the invisible foundation of all fiat systems, fractures. When confidence dies, the currency follows. Sirs. The final trigger, the new system arrives. Reserve currencies do not collapse into chaos. They collapse into replacement. When the Portuguese real fell, the Dutch guilder rose. When the Dutch guilder fell, the British pound rose. When the British pound fell, the US dollar rose. A new system is already forming today, not one currency, but a multipolar structure, a Chinese-led settlement network in Asia, a commodity-backed system among BRICS nations, regional currency blocks in the Middle East and Africa, a digital layer of value transfer independent of any nation-state, gold reclaiming its historical role as the ultimate neutral asset. The world is not preparing for a post-dollar vacuum. It is preparing for a post-dollar architecture. The next reserve system will not be a single empire dominating trade. It will be a distributed network, one where no single country can weaponize the currency of global commerce again. This is not speculation. It is trajectory. 7. And this is why the outcome is unavoidable. The United States is not collapsing. Its currency regime is. America will remain powerful militarily, technologically, culturally, economically. But the dollar's age of unquestioned supremacy is ending because the cycle is not emotional. It is structural. It is mechanical. It is mathematical. Every empire follows the same pattern because every empire, eventually, begins to believe the same lie. We are different, but the currency death cycle does not care. It has repeated for 600 years without exception, and the US dollar, 81 years into its reign, is now entering the final stage. The world is shifting. The system is cracking. Confidence is thinning. Alternatives are emerging. Debt is compounding. History is converging. And that is why the outcome is not dramatic. It is inevitable. This is the pattern. This is the cycle. And we are already living in its